Hey everyone, my name is Cam. I am the co-founder and CEO of Investipal. We are an investment research platform to get you up and running, managing your own portfolio confidently. I am joined by Abdi Jama. Abdi, why don't you tell everyone about yourself?
Hi everyone, my name is Abdi Jama, like Cam just introduced, and I am the co-founder and CRO of Investipal. And yeah, I really just joined Cam on this journey, and we wanted to really just make investing accessible to everyone and as easy to do as possible, and the best way to do so.
The format for a lot of these
So,
conversations that are the basis for our podcast. Investipal has this mission on letting you confidently invest on your own, but a lot of what Investipal was born from was essentially conversations just like this, where, Abby, you'd call me up and we would have a back and forth dialogue on what's going on in the markets right now and how you can invest. And, really the overall goal for this podcast and the future series is to bring on people, just have a very basic
oh, you're
dialogue of what
frozen.
we see going on in the stock market and really what it means for an individual investor.
Yeah, I think, Cam, I think similar to me when I was going down the rabbit hole over the pandemic, really just placing my bets on individual securities and doing that abundance of research of individual stocks that, would come across my WhatsApp groups and Instagram and even some of the Twitters that are still coming across today makes things, really enticing to join and buy into. But I mean, a perfect example, what's going on today? I mean, we have banks folding, your money's not safe. I mean, stocks plummeting, people's investments aren't safe. What's going on? What do you, in your opinion?
Yeah, it's like a reminiscent of 2007, and I think both you and I are like right on the verge of we knew what happened, but we weren't really in the industry just yet. But you had a lot of bank difficulties kind of forming, the dark clouds forming, and then one goes down, the rest start to crumble. And Silicon Valley Bank was that catalyst for this current turmoil that we're going through right now. So to give you some more context, Silicon Valley Bank primarily focused in on funding startups. They do a bunch of venture debt. Really, if you do want to spend a lot more time understanding everything, there's a great podcast, the All In podcast, with like Jason Calacanis, all those guys that can dive in really into the weeds on specific issues within that area. But essentially, what's going on with the banks right now, a lot of these regional banks, they have a lot of hold to maturity securities. And what that means is,
Hmm.
typically a bank, let's say I get a mortgage, the bank is going to take that mortgage, securitize it with 1,000 others, and sell it to other investors. So they're not directly holding it on
Hmm.
their balance sheets. They will hold some securities on their balance sheets that
Hmm.
covers deposits. Essentially, the bank's all about taking short-term deposits and lending against that. Um, so essentially, there's an interest rate spread. They might charge you 1% for what you're holding in your checking account, but they're going to take that money and loan that to individuals or place that into securities. But what the Fed's been doing in the US and even in the Canadian market, they continually raise interest rates higher and higher and higher. When you raise interest rates, bonds trade inverse to
Yeah.
that. So while interest rates go up, bond prices go down. So the value of their book that they're holding decreases. So now you're in a position where, in like Silicon Valley's bank's case, they have a bunch of deposits, but if people wanted to withdraw their money from that, they have to take their securities and liquidate them to fund those deposits. However, if those securities are down
Hmm.
20%, then they're in a capital position where the bank is essentially insolvent. So that's where you can get into the issues of like a bank run, where really consumers start to lose faith in the bank's ability to actually fund the deposit, and it's a self-fulfilling prophecy in a lot of senses where if I lose confidence in my banking institution, I'm just going to take my money out. It's no risk to me to take my money out. It's my money. However, if 10,000, it's like a
Hmm.
prisoner's dilemma. If 10,000 other people have the exact same idea, they're just going to go withdraw their money. That bank's going to fold. And that's what you've seen with Silicon Valley Bank. You're starting to see that with other regional banks like First Republic. They've had to get a $30 billion cash injection from a lot of the big institutions like Bank of America, JP Morgan Chase. Um, and essentially, the government, the FDIC, they're trying to instill a sense of calm with individuals that your money is safe. Stop withdrawing it to prevent the
Yeah.
rest of this kind of banking calamity from taking hold.
Right. And I'm assuming, anyone who's got over or under 250K, if they all start pulling their money out at once, then we've got a real problem with every bank, right? Because you're looking at a larger audience there of individuals that have capital in the bank. Not everyone has $1 million sitting there.
No, like your money is safe up to
But obviously, yeah, this is
yeah, like it's safe up to $250,000 by the FDIC. You saw them come in on a Friday to Silicon Valley Bank, and by the Monday or shortly thereafter, people were able to access their funds. However, to your point, Abby, like if you had more than 250K in there, you're kind of screwed, and you're hoping that the government steps in or the FDIC steps in to honor above that insurance limit. The other option is to start to
Mhm.
look at other banks that offer higher minimums. Like we do some banking with Mercury. Mercury has like a $5 million FDIC insurance policy, so I can keep Investipal's money up to $5 million within that, without being at risk of us losing all of the money in our bank accounts.
Right, right. So I guess my question is, now you mentioned, getting the bigger banks to bail them out. And, we're looking at the classic margin call domino effect happening, or I guess kind of starting to happen. But, how does this relate to because all my feeds have been filled with and my media and my news outlets have been filled with, SVP and startups and smaller banks. But, tell me a little bit about Credit Suites. What's happening there, and how does it relate?
So a lot of the banks are falling in the same issue right now, where they're holding a lot against their balance sheets. A lot of these hold to maturity securities that aren't worth as much as what they were historically because of the interest rate environment we're in. So overall, you've
Right.
seen, since COVID, the amount of money that all of the central banks have been injecting into the economy has caused a rapid sense of inflation where our prices keep going up and up and up. Um, they've had to now raise interest rates to try to quell that. Because they're raising interest rates, it's becoming more difficult to manage your loan book. So for a lot of these banks, for them to actually be able to manage their liabilities, because for a bank, they have a liability to the depositor to honor that. So they're holding a lot of these assets on their balance sheet that aren't worth as much, where they're not able to honor depositors. So, in the case of Credit Suisse, like they're now getting folded under UBS. You're seeing protests all over Europe right now. Like, people are raising up against the French government for trying to increase their pension age to 67. I think it's 67. We'll fact check that one. But there's a lot of issues going on because there's been so much debt in the market for so long now. And, the past decade, it didn't
Mhm.
matter. Interest rates were so low. I'm going to take on cheap debt to fuel my spending habits. I might be an individual who makes $50,000 a year, decent salary, but my house might be worth 300,000, but I bought it for 100,000. Why don't I just go get a home equity line of credit? I can take $200,000, whatever it may be, and start spending it on nice things that I want. I can buy some clothes, I could buy some toys, I could buy an RV, and it's fine. My house is essentially financing my life. And for a very long time, you were able to get away with that. Now you're not able to. Interest rates are at a point where you're like, okay, crap, like I need to reverse course here. I need to start paying off a lot of this debt that I've accrued. My house value is stagnating. In many cases, it might be declining now. So I actually might owe more on my house than what it's worth. So a lot of people, I think, are starting to panic with, I need this money to fuel all of my growing debt. I have a lot of basic necessities that are even more expensive now because of inflation. And there's a lot of uneasiness going
Yeah.
on in the Western world where if the if the governments and the central banks don't step in to instill that sense of calm with individuals, potentially pausing interest rate hikes,
Mhm.
it could become very precarious for not just the stock market, but entering in more of uh, a really serious recession.
And you said stock market too, and I'm thinking, okay, when Monday morning, Sunday morning, I'm thinking, the only thing I'm seeing, I'm not, I know about the interest rates and the bond values and what's happening in the industry, but I'm thinking like the retail investor doesn't, and they don't understand, how things get affected by the interest rates increasing and the overall market. So, I mean, I guess my question is, when I wake up, I open my Instagram and I see the first post that's put up, Credit Suisse is now a penny stock. Another big bank is now going under. That's going to strike some serious fear in the market. And how does that, I mean, where do you think that, risky bets are starting to happen for that Main Street retail investor that doesn't understand entirely what's happening other than the memes and the stocks?
Yeah, to your point,
Twitters.
like I think, one of the reasons we started Investipal was because of how we've been seeing retail manage their own money. And what I mean by that is,
Mm-hmm.
for a long time, you could take individual bets on different securities and hope that you can make it big. So I am going like the GME is the perfect example. I think that GME is a great stock. It's going to keep going up. For whatever rationale I have, whether it's off of Wall Street bets, whether I've done my own due diligence, whatever it may be. But it's really treating investing as trading. And the delineation between those two is
Mm-hmm.
trading, you're doing it for very short-term periods, hoping that the stock jumps up in value, or if you're short, hoping that it decreases quite quickly. Investing is taking a very methodical approach to taking your nest egg, taking your regular contributions, identifying what resonates with you, identifying your risk tolerance, and consistently investing into that. So what we've seen for so long is these individuals go out
Right.
there, they buy single stocks, they hope that they can make it big, but
Mm-hmm.
that's really not a sustainable way to grow your wealth over time. It's essentially like buying a lotto ticket. So what do I?
It's sitting at the
Yeah,
table.
exactly. Yeah, you might hit it big a couple times, but by and large, the house always wins. So
Yeah.
you know,
Yeah.
like the way that we've built our platform here was for you to be able to go research investments that resonate with you. You build your portfolio, you set it, you forget it. Maybe you come, you check in on it once a month, once a quarter, but you're not doing any sort of high frequency trades. And I think like right now, especially with how everything is situated, the thing is it's time in the market, not timing the market. So it's never a bad time to invest.
Mm-hmm.
But I think retail investors, individual investors out there need to be very cautious on what they're buying right now. For instance, like First Republic Bank, you might see that it used to be at
Mm-hmm.
$100. It's now at like 20 something at the time of recording this. Um, and there's news coming
Mm-hmm.
out now about a second bailout. So, a lot of the big banks already injected 30 billion. They're trying to round up more capital now to inject back into it. It's not necessarily, going and catching these falling stars and hoping that they mean revert back up. Because if we actually enter into a recession now, valuation really does matter. And you need to be willing to undergo a lot of pain for a long time to grow your wealth. So I think now is the perfect time for investors to start thinking a bit more rationally on how they go about things. When interest rates,
Yeah.
here's a good example. For the past decade, tech stocks have performed very, very well. Do you know why? Like, do you know how tech stocks get
Mm-hmm.
valued?
I guess the SaaS model and the future
Yeah.
valuation of that
Yeah,
it's more
essentially, they're
predictable.
taking
That's just.
yeah, like they're taking future cash flows and they're discounting it to a present value. So
Mm-hmm.
if I can reliably forecast out that, like, let's say in the case of Google, that Google's revenue will be $1 billion in 5 years from now, I can apply a present value calculation on what it should be worth today. But one of the key factors in that present
Mm-hmm.
value calculation is the interest rate today. So, and that's in the denominator. So as that
Right.
interest rate increases, the present value of those cash flows isn't as high. So naturally, when interest rates go up, stock prices, especially growth companies, go down. And that's a lot of what you've seen
Yeah.
in 2022, 2023, where the Fed aggressively hiked interest rates. So what did that hit the hardest? It hit tech valuations the hardest. And a lot of people for a very long
Hmm.
time had a really big tech weighting in their portfolio. We actually wrote about it in one of our blogs months ago, probably almost a year ago, about how you're probably holding an undercover tech portfolio purely if you owned, the S&P 500. It had, I think, about a year ago, had about 30% weighting in tech. So you think that you're owning a diversified portfolio, the S&P 500, that a lot of notable investors like Warren Buffett just go and say, hey, you should just buy the S&P. If you did that, you had a really high
Hmm.
correlation with the tech sector overall, just because how large those companies became. Um, so, I think
Hmm.
like back to my previous point, like if you are becoming a more rational investor these days, you need to think about your portfolio not just on buying single stocks or by liking single stocks that resonate with your familiarity, but start to factor in other considerations like what's going on in the macro environment right now, what's the 10-year outlook look like? And I can factor that into my portfolio. And instead of thinking about these individual securities, I can think about these individual securities within my portfolio to say, um, you know, basically,
Is this worth setting and forgetting in my
yeah,
portfolio?
and are they uncorrelated? Like if something bad happens to one, it's not necessarily going to be a domino that wipes out the rest of
Mhm.
my portfolio.
What other correlations do you think you should consider outside of if something happens to one, it's not going to. What else do you think you should consider when it comes to correlation?
Um,
Macro
so I think
trends,
a very good, like, do you know what a contrarian investor is?
yeah, but maybe for the sake of the pod, just let's give a brief
Yeah,
overview.
so like, contrarian is someone who's going against the fold. So typically, like whatever everyone else is saying you should do,
Mhm.
they might be saying the opposite. So in a contrarian sense,
Right.
like if you look at it, what is the rest of the investors talking about right now? What is the rest of, the media talking about? If they're stoking a ton of fear, then it might not be a bad time to be greedy. There's when there's blood in the streets, money's made. There's a lot of different sayings that go on about being a contrarian thinker, because if everyone's becoming very negative right now, it typically is a good time to invest. However, we are still in the very early innings of what's going on, especially with what's going on in the banking sector right now. So, for instance, like Charles
Hmm.
Schwab, one of the largest online discount brokerage firms in the US, took a real big beating. Why is that? Because you might have a $100,000 portfolio with them, but you have $20,000 of cash sitting in that account waiting to deploy. Well, they're treating it just like a bank would. They're taking some of that money and they're investing it into securities so they can earn a little bit of an interest, a little bit of income off of that through interest. So that money's not insured. There was a lot of risk of maybe they're the next one to fall. Um, what I'm trying to get at here is, to be a contrarian, you have to take into consideration what everyone else is talking about. Layer in your own thinking
Yeah.
behind this. So, if I have a lot of cash sitting, I can do some due diligence around like, am I going to be exposed? Do I need to put my money into securities? Because at least, maybe if I put my money into a money market fund, that is safe versus if I just keep it into my
Hmm.
Charles Schwab checking account or cash account, whatever it may be, that money's not necessarily guaranteed. So you can take some precautions there, but you can start to see like what is really going on, what is the messaging being put out by the media right now. If everyone is very, very negative, that's not a really bad time to buy. So what I would be doing right now is revisiting my portfolio, seeing if I have anything that I don't want to hold for the next 5 years. It's tax time. Maybe I can drop that off, earn some tax harvesting off of that. Um, but starting to think longer term around the lens of what is the financial landscape going to look like? Interest rates are probably going to stay higher for longer. So not necessarily going right back into tech isn't the best thing. Maybe I should start looking at securities that are a bit
right
more
now?
fairly valued. So, the value, there's different factor styles out there. We layered into our into Investipal, but essentially, there's like a value versus growth argument that's supposed to be mutually exclusive. It's not necessarily, but a value stock is one that's fairly valued versus its peers or versus historicals. So it's looking at companies that are profitable, trade at reasonable valuations, so they're not trading at like 30 times earnings, and building my portfolio around that.
Commodities, for example.
Well, like commodities work
Yes.
in an inflation environment, because as prices go up, the raw goods increase in value. You can own companies that mine those. But typically, like you could look at gold. Like gold is a very good example. Gold is supposed to be a safe asset. So if you don't feel very safe right now with the banking sector, you might want to own some gold. And if you look at what's going on, like the time we're recording this is March 20th, the gold prices have shot up because investors are losing faith in currencies right now and in financial institutions. So they're going to put into hard assets
Mhm.
like gold. So in that sense, they're owning the physical commodity, and gold is a really easy case to do that. You'd and the natural assumption is,
Mhm.
well, why don't I own the companies that produce the gold as well? It is a reasonable assumption to make, but historically, it hasn't really worked out in your favor because gold on average has returned more than the actual gold mining companies, despite their ability to make more money. So you can look to commodities and other areas like that, but they can be very volatile as well. So if you're a more risk averse investor, maybe you're saving up for a house and you're only looking at like a 5-year time horizon. To be honest, like putting it into some sort of a
Mhm.
guaranteed investment vehicle, like in Canada we have the GIC. That's probably your safer bet because it does increase with inflation because they're hiking interest rates. But you're not necessarily having to stomach all of the risk that's going on in the stock market right now and all that volatility that we've been seeing.
Right, right. And so I guess from what it sounds like and what I'm hearing is that you typically don't add securities to your portfolio unless you're comfortable with it being in there for the next 5 years. Your confidence is high with it,
Yeah.
and if the market is really shaky, you start moving towards value securities and
So yeah,
some commodities, GIC, SIG.
what I would say is when the market's really shaky like this, you have to do some analysis to say what's causing that calamity. Typically, what you can do is you can go into low volatility areas. Those low volatility sectors include
Okay.
utilities, consumer staples, and in this case, a bit ironically, financials. So maybe in the sense you don't want to include financials in your portfolio, but you would look to utilities because at the end of the day, everyone still needs electricity. Consumer staples are really like food producers or grocers. They're beneficiaries to the inflationary environment right now, so you could look to something like that. It's not necessarily value stocks, but if we're entering a recession,
Mhm.
value typically works the best out of that cycle. So as the economy starts to reboot, what are the pressures on that? Well, people start buying more things. Well, to produce those things, you need raw materials. Those raw materials and the producers of those things are typically what work best. So in the value camp, it's usually like industrial companies and mining companies.
Yeah.
So you can look towards some of that, but again, it all fits within your risk profile. So again, if this is like your 401k account and you're looking to invest for 30 years, it doesn't really matter. You have a really long-term investment horizon. If you are shorter term, maybe you should look towards some money market funds. If you're willing to have a little bit of risk, you could do some low volatility investments. There's actually an interesting way that you can actually minimize your portfolio volatility. So you can buy whatever you want and you can do an optimization on it called minimum volatility. And essentially, it takes into all the consideration the historical price moves of your portfolio and tweaks the weightings of those. That's something that we're actually including into our product as well. So there's a bunch of different things you can do.
I was going to say, yeah. So how are you including for my portfolio for when I think about it? How are you including that, minimizing the risk of the volatility?
Yeah, so there's two ways that you can think of it. You can think of it on an individual securities basis. So like that is a low volatility approach.
Right.
That is saying I'm going to go buy five utility stocks. Maybe I'll buy a consumer staples ETF. Maybe I will buy a renewables energy company or something like that, something a bit more stable. Um, and those companies might exhibit low price volatility, which means like they don't move around a lot. They're pretty consistent. However, a lot of those can have very high correlation with one another because like one utility company is very similar to the next utility company. So the other way you can look at it is on an overall portfolio basis, is that minimum volatility approach, where you use essentially an algorithm to you plug in your portfolio weights. It looks at the price histories overall, and it try to it minimizes the correlation of your portfolio in aggregate. So the individual holdings, ironically, could be very volatile, but the way that the portfolio is constructed, it kind of cancels itself out. So while
Yeah.
one might spike up, the other one might spike down. Net net, your portfolio is flat. So you can think of it along those lines. It is a little
That
bit more
doesn't sound very
complicated to
predictable.
think of it like that. But there's actually quite a few
Yeah.
ETFs out there. iShares has a big lineup called the Minvol products, which do just this.
Very nice. Yeah, that's great. I guess my next question is I guess I don't really have two more. I guess too many questions after this. I mean, really, how much worse do you think the market's going to get if we're going to look into the future here? I know you said that things are. This is just the beginning. What do you mean by
Yeah,
that?
so Jerome Powell, the Fed chairman, speaking on Thursday, and
Yeah.
investors are really focused in on what he's going to say now. The market has been pricing in another interest rate hike, and he's been very vocal that they're planning on
Hmm.
continuing to hike interest rates. But back to rewinding to what we were talking about earlier, when interest rates go up, bond values go down. So if a lot of these banks are holding these fixed income securities, they're going to get valued even lower, and that might stoke more fears in the market where you might have another bank run. On the flip side of things, if he doesn't raise interest rates, inflation's still quite high, and it might stoke that further. So they're in a very difficult spot right now where they want to quell the fears in the market on issues within the financial sector. But for them to be able to do that,
Yeah.
they need to pause or start looking at cutting interest rates. If they do that, though, then inflation continues higher. And you and me and everyone else, it's going to be more expensive for us when we go to buy our groceries or we go to fill up at the pump.
Mm.
So, that is one of the key events that people are focusing in on this week along the lines of like what is the Fed going to do, and are they instilling a sense of calm within the market and amongst the general populace? And if they're not, then the market could certainly start to turn lower. A lot of the news that's come out today, like again, it's March 20th when we're filming this. The stock market's up, and
Yeah.
that's because there's news that UBS is buying Credit Suisse. There hasn't been another bank failure, but there's still a lot of
Mhm.
indecision going on right now on what's really going to happen. It's very interesting times.
That news with the UBC and Credit Suisse, it's really just giving the market a hit of dopamine, and then it's just going to go right back to, okay, now what's really happening? Interest rates are still going to go up. We're waiting for that announcement to come later this week. So what should we be doing? I mean, what should I? How? I guess should I? Everyone. I should be. I don't want to speak for everyone. I'd like to say everyone, but really just start focusing in on owning the value portfolios and low volatility until the storm weathers out. Essentially, is the best way to go about it.
I think the best approach is always to think about your portfolio overall and don't have a ton of concentration in one
Mm.
particular area. Um, you can think of it along those lines. I don't necessarily think you need to go out, sell everything,
Yeah.
um, repurchase whatever, whatever's to your liking, but you can certainly take a more methodical approach on reviewing what you own and thinking to yourself, like you could plug it into our calculator, we'll spit out all the correlations and whatnot, so you have an idea of that. And that can give you a sense on like, do I need to rebalance things? Do I need to drop off some of my financials exposure because of what's been going on in the market right now? Is it a good time to, maybe you own tech.
Hmm.
Like, I wouldn't sell tech necessarily at this point just because that sell-off has already happened. If they do start cutting interest rates, then that's going to be good for the tech sector again. Um, I just think it's taking this more methodical approach on reviewing what you're investing in, remembering that if I actually am an investor, not a trader, I need to be considering about my entire wealth, not just betting on single stocks and hoping they make it big. It certainly will be probably more of a stock pickers market going forward. And really what the meaning behind that is, historically you could go out, you could buy an S&P 500 ETF, it's going to yield you 10% over the long run, over the past 90 years. But there's certain areas within that where it doesn't work so well. And that's really where when it's a volatile market and you have like a lot of regime changing. So, historically it was tech. The past decade it was tech. You could have just gotten away with owning the Nasdaq stocks. It would have yielded you much more than the S&P. But now we've seen that roll over, and now you're starting to see more of those value-oriented stocks work out better. So when I say stock pickers, it doesn't mean you have to go out and buy individual stocks hoping that you make it big. It's more so thinking along the lines of what sectors are starting to work well right now and what are more durable. And certainly in this environment, that inflation sensitive but overall stable business models like a grocery company, like a consumer staples sector would probably work best.
Um, Anything happening with the Canadian banks anytime soon? I think that we're okay here. But the Canadian markets, do you think we're going to see uh, similar correlations, I guess, or similarities?
So yeah, when you look at what's been going on in the US market, it's amongst regional banks. It's everyone's essentially losing comfort
Hmm.
because they're not under the same sort of regulations that
Yeah.
the too big to fail banks encompass, which, JP Morgan, Bank of America, like very big brow banks. Essentially the government's saying like we're willing, you guys aren't as important. You can take on a little bit more risk. If you
Hmm.
fail, it'll be shitty, but you're at least not going to ruin the entire economy. What we're seeing now is that's not the case. Like Silicon Valley crumbled and it's starting to show cracks elsewhere. So you've seen a lot of people take their money out of these
Yeah.
regional banks and put them into the top tier banks. In Canada, it's very much the big five or the big six, TD, Royal Bank, CIBC,
That's it.
Scotia, BMO. They've been able to weather the financial crisis perfectly. Um, is that to say that history is going to repeat itself and the Canadian banks are going to be perfectly okay? Not necessarily, because in Canada, there's a very high degree of consumer debt, more than the US, and it's very concentrated around mortgages as
Mm.
well. So if you think that the Canadian housing market is going to hold strong, then the Canadian financial center is going to be okay as well. If we do start to think that house prices will decline in value, overall they've been still somewhat sticky. Then you might see a little bit more difficulty amongst the banks because you have more people not being able to pay their mortgages. If there is a run, where are you really going to put your money unless you're keeping it under your sleeping bag or your mattress? Sorry. Um, so I think overall the
Mm.
Canadian banks are okay. If you look at the TSX, it's really amongst the TSX 60, and there's even a smaller subset, and it's called like the oligopolies. It is the Canadian banks, it is the
Yeah.
grocers, the telecoms, and the railways. So like really in Canada, you can get away with just owning those areas. It's really like 20 stocks, and you'll perform just fine. And those are very high quality companies with very predictable, stable cash flows. If you look beyond that, then you're looking at like a lot of oil and gas companies, and a lot of mining stocks.
Hmm.
Those are much more variable. They do work well in an inflationary environment, which is why the Canadian market's been doing quite well. But they're much more volatile. So, if you're a Canadian investor and you want to be a little bit more risk averse, you can look towards those top quality oligopoly types of companies. If you want a little bit more risk, potentially higher reward, you could look to some of those mining and oil and gas stocks.
And then everything else after that, utilities, and it all goes down the
Yeah, like utilities, it doesn't really matter what
same
market.
idea.
Like, in Canada, you have a lot of renewables types of companies. You have like the Brookfield suite, like Brookfield Infrastructure Partners. They all do quite well. Um, but overall,
Hmm.
those are going to be very similar, agnostic of what market you're in, because they're essentially monopolies. They have very stable customer bases. They know what they're going to charge. There's not a lot of issues there.
You're kind of making a monopoly not sound not so bad right about now, but yeah.
Regulated monopolies are a bit better.
But no, this is. I guess what we could do here is we can tie it back into our core mission. I mean, everyone's out to go after the same thing, get ready for retirement, look for that stability and that cushion, and oftentimes it could be found in the markets, in the stock markets, and so giving the right tools out there for people to be able to do exactly this, thinking about it without having an in-depth macro understanding or even like a quant background, really understanding things in a macro lens. So I want to thank you, and let's tie it back into our mission here. What else do we have here? Do we you think we should
Yeah, no,
cover?
I think that's a great first wrap. If anyone's reading this, watching this, they have some comments on what you'd like us to cover, please let us know. This is our very first one, so we will get better over time. Our overall mission is to enable the individual investor to invest confidently on our own. We want to do that through our podcast. We want to do it through our app. You can sign up for free, investipal.co. We'll help you manage, well, the platform will help you build your portfolio. It'll give you all those factoids I was mentioning before, so you're left more informed. But if there is anything more macro you want to cover, any questions or whatever, Abdi and I are here. You can shoot us an email, info@investipal.co, and we will get right back to you.